first to our stock of the day, also making news. ASX has hit the pause button on replacing its CHESS clearing system, and Accenture saying it will review aspects of the CHESS replacement project, which has currently cost the business in the range of $245 to $255 million. And in fact, Reserve Bank Governor Philip Pepe saying the announcement by the ASX after many years of investment by both the ASX and the industry is very disappointing. It needs to prioritise developing a new plan to deliver safe and reliable clearing and settlement infrastructure. Just taking a look at how the stock is performing today, it is down, has made a bit of a comeback, but was down about 2%, now down about 1%. So let's see what our experts think of ASX, given this has been going on for years, Mark. Disappointment, as Philip Pepe has said. So what do you make of that latest announcement?
Yeah, while the ASX is a monopoly, it's showing true colours of a monopoly, basically, by essentially not executing on their plans because they don't have to. Look, this has been going on for forever. There was whispers around that they were going to pause or even cancel this for quite a while. Their inability to execute despite the monopoly, it really doesn't attract me at all. I think on the futures side, we've seen some major market participants resign their licences recently. That's still a fair chunk of their business, but with the bond market volatility, which is what I used to trade, volumes are down fairly significantly there as well. Many other countries, have seen the emergence of ICE come in. We've got CBOE here in Australia now. We're taking over Chi-X as well. I'm not entirely sure why. Maybe we're not big enough for them to come in and have a real swing at the ASX. But look, if this sort of inefficiency sort of keeps continuing, it's going to be pretty easy pickings. There is a fledgling exchange, FEX, in Australia as well, Financial Energy Exchange, which is, it's taken them a while to get their license, but if they potentially can gain some momentum. So I don't think ASX remotely justifies any sort of premium here at the moment. I think they really need to have a look internally and get things sorted out, because as a business, if it wasn't a monopoly, I think it'd be significantly lower.
So get its house in order. You're saying it's looking vulnerable then. So you're saying then you wouldn't be holding on to the stock?
I'd be a seller, basically. I don't think it yields enough. It traditionally has a premium on the stock because it's a monopoly, and I just think there's enough money there. It's a matter of time. If they keep easing the barrier of entry to other exchanges in a digital world, I think you're going to see someone just come in and just make the ASX or Australian share market a bolt-on, as opposed to where traditionally it's ASX has had a great reputation and held that monopoly well. Well, I don't think they can continue to do these sorts of things and expect that monopoly to sort of continue, because there'll be money there for someone.
All right, Philip?
I think the opposite, but for similar reasons. I think it's a buy. It was disappointing to hear today's news, but as Mark said, this has been largely flagged. It's been taking so long. And to put into context, they're suggesting a write-off of 250 mil. It's 1.8% of its market cap, 2% of its market cap, hence the share price move. So sounds a lot, but it's actually not that much.
And probably not unexpected.
No, I mean, people have been waiting and geez, it's better to walk away rather than keep burning more money on a project that isn't going to work. Yeah, they probably need to spend another 250 mil, so take another 2% off. But as you saw in the chart earlier, it's almost at 3-year lows. It's bounced a bit. The ASX is a monopoly, and they can almost do what they want. They can charge what they want. If your volumes have fallen, we all know fixed interest volumes have fallen, equity market volumes have fallen. I know that very well. IPOs are all on hold, etc. So you're buying it if you buy today with a very pessimistic forecast. We know equity markets work longer term. We know capital markets will come back. Companies will list again. Companies will look to raise capital. Turnover will increase in more normal times. So better to buy a company like the ASX at a 3-year low than a 3-year high, given the expectations are quite low, given negative news today, and why can't they fix it? So for me, for the genuine long-term investor, and you buy the ASX exists, among other reasons, to provide liquidity to shares. now's a good time to buy it on a 3-year view. It might be choppy for the next 12 months, but if you think 3 years plus, $70 is probably a good entry point.
To Mark's point, do you feel as though it's vulnerable at this point? You know, when you've got the likes of SIBO there, perhaps trying to muscle their way in further?
Chi-X, others have tried to muscle their way in for a while. SFE used to be separately listed until they merged. Would have happened by now. You're probably not going to muscle your way in during a bear market. You probably do that during a bull market. Subject to takeover rules, maybe it's subject to takeover. Unlikely, I think it'll be not possible for a foreign entity to own it. But would make more sense for someone to buy it at this price and say, right, we'll do what you can't do, rather than to someone enter in, pessimistic view on markets at the moment. You don't.
Yeah, the regulators have flagged in the past that they wanted Australian owned. And look, and if they do get their house in order, I'll have another look. But at this point in time, that's it really needs to improve its game before we start looking at it again.
All right, well, there's a differing perspective right there, just as far as ASX is concerned. Just before we get into the stocks as picked by you, Phil, how are you seeing the broader market at the moment? In fact, how closely you're paying attention to what's going on at the macro level? Just got the latest jobs numbers out today, unemployment falling again. Are you sort of top down, bottom up? How are you looking at it at the moment?
I'm a bottom up analyst, but I always look at the top down periodically, every month, every 3 months, and we had a presentation from our Chief Investment Officer earlier in the week. From a macro point of view, the worst seems to almost be over. US inflation is still out of control. We've got full employment. That's both a problem and an opportunity for some of the companies I look at and that we'll talk about today. But I think the view in the two economies that matter most to us, Australia and the US, is while the interest rates will keep rising, and we're not there yet, they'll keep rising at a slower rate. And for me, that's a sign that maybe the markets have bottomed, maybe not quite at the bottom, but the US may not raise by 75 bips next time, maybe it's 50. We've moved from 50 to 25. There's debate as to whether we go another 100, whether the US goes another 100. I think consensus is for the US to get to 5% cash, and for us 4, 3.5, 4. We're almost there. Let's say we get there in 3 months or in 6 months' time. I think the worst is almost behind us from a macro point of view. Inflation's not quite under control, but it's moving in the right direction, so we don't have to hit the handbrake harder. So it's not as bad as it seemed back in September when the world was coming to an end and equity markets were falling away pretty aggressively.
So potentially a Santa rally. Even as we're seeing now, we have rallied.
Potentially, yeah. Potentially Santa rally, potentially people closing their books into Christmas.
Yep.
But I think a first half calendar 23 was probably more likely to be positive than negative.
Okay, Mark, what's your view?
Yeah, we sort of start top down, pick sectors and then try to pick best in field. Overall, I sort of agree there'll be buoyancy into Christmas, but I think it'll still be largely volatile. We've got one more inflation print, one more FOMC, one more RBA. So those can still throw a spanner in the works overall. I agree with Philip's view that inflation and rates, now we can see the light at the end of the tunnel, and thankfully it's not the oncoming train. And essentially, I'd be more positive probably first quarter of next year when we get a few more data points and we can really confirm that inflation has peaked and that interest rates are going to be going towards a peak as well. And we'll probably, I think next year will be pretty range bound. I really don't see us breaking this 12-month range next year overall, and I think it'll be very much a stock pickers market because we're still dealing with the aftermath of obviously pandemic, QE into inflation and tightening. I don't think those things get solved in the blink of an eye. So I think next year you'll be still playing ranges overall, and try to. It'll be still sort of focused on that value end rather than the growth end, and maybe start to pick up some of those quality growth companies on a longer term view, particularly towards the end. If we're one rate hike away from the end of the cycle, sort of thing.
Yep.
I think that the market by that stage will be past worrying about interest rates.